everyone, welcome to our Group 4 presentation. Our presentation today is about IFRS 5, which is non-current assets held for sale and discontinued operations. The team members are Morgan, Gerard, King, Venus, and me, and we will use Bombardier Inc. and Enbridge Pipelines Inc. as examples in our presentation. In the next slide, Venus will take over me to start with the purpose and scope of IFRS 5.
IFRS 5 focus on two main areas. The first area is the accounting treatment for assets or disposal group held for sale. The second one is the presentation and disclosure requirements for discontinued operations. The users of financial statements, like investors, should be informed about a company or another entity's plans to sell some non-current assets and discontinue some operations because it might affect its future cash flows, profitability, and the overall financial situation. To highlight the results of discontinued operations and to separate them from the results of ongoing activities. The measurement requirement of this IFRS apply to all recognized non-current assets and disposal groups, as set out in paragraph 4. IFRS 5 requires that immediately before the asset is classified as held for sale, it should be measured under its applicable IFRS. Subsequently, after it has been classified as held for sale, it must be measured at the lower of its carrying amount or fair value less cost to sell. Assets that meet the criteria to be classified as held for sale to be presented separately in the statement of financial position, and the results of discontinued operations to be presented separately in the statement of comprehensive income. There are some exceptions for measurement of these assets listed in paragraph 5, which shall continue to be measured in accordance with the standard note. First one, deferred tax assets. Second one, assets arising from employee benefit. Third one, financial assets within the group of IFRS 9. Financial instruments. Fourth, non-current assets that are accounted for under the fair value model in IAS 14, investment property. Fifth, non-current assets that are measured at fair value less cost to sell in accordance with IAS 41, agriculture. Sixth, contractual rights under insurance contracts as defined in IFRS 4, insurance contracts.
So, classification of non-current assets or disposal groups held for sale. This is defined as a group of non-current assets or liabilities to be disposed of together as a group in a single transaction. An entity shall classify a non-current asset or disposal group as held for sale if its carrying amount will be recovered principally through a sale transaction rather than through continuing use. However, it must meet two conditions to properly qualify, being available for immediate sale, and the sale must be highly probable. And we'll cover what counts as highly probable on the next slide. What makes a sale highly probable? 1. Management must be committed to a plan to sell the asset. 2. An active program to find a buyer must have been initiated. 3. The asset must be actively marketed for sale at a price reasonable to its current fair value. 4. The sale is expected to be completed within 1 year from the date of classification. And 5. Significant changes to the plan are unlikely. The purpose of this is basically to create predictability in the financial statements for financial statement users. So you basically don't have massive asset classes shifting around back and forth in the financial statements, creating huge inconsistencies. However, there are exceptions for circumstances beyond the entity's control, and there is sufficient evidence that the entity remains committed to its plan to sell the asset or disposal group. So what happens if the non-current assets are not available for sale? Then they would have to be categorized as non-current assets held for distribution or abandoned. Non-current assets or disposal groups held for distribution to owners. This is when the entity commits to distributing the assets back to the owners or shareholders. To qualify for this, the entity must be 1. Available for immediate distribution, and 2. The distribution must be highly probable. To count as highly probable, the entity must have already initiated the process of distribution, and it can commit to accomplishing the distribution in a year. Significant changes must be unlikely. It also mentions that shareholder consensus should be considered if relevant. So, non-current assets to be abandoned. In IFRS 5:13-14, it essentially says, if you abandon an asset, it clearly wouldn't meet the definition of a sale. Therefore, you can't account for it as held for sale. This is because its carrying amount will be recovered principally through continuing use. As well, you can't count an asset as abandoned if it's just temporarily out of use. An example of this would be a mining company shutting down a site for the season. However, if one of those big mining haul truck things slid into a ravine, then it would have to be abandoned.
Thanks, Morgan. And now I will cover some examples of how assets for held for sale are classified on one of the two companies that we selected. Just for a quick summary, the Enbridge Pipelines is a Canadian Calgary-owned, Calgary-operated company, pipeline company, and the business model for the company is the transportation of crude oil, natural gas, through various pipelines owned by the company throughout Canada and the US. And the highlighted asset for held for sale is a separate identifiable asset classified on December 31st, 2018 and 19, is a line 10 type of a pipeline, which company classified as held for sale. So this is like followed by the last slide, where the company recorded the assets held for sale in 2018 and 2019, and they also recorded the impairment loss in year in 2018, coming from the sale of this asset. Also, this is providing an example of paragraph 9, where the sale goes beyond 1 year. One of the exceptions, because the pipeline company is operated by Canadian regulatory boards, and they have to get some approvals before the actual sale has been made. And according to this the note, it states that the sale is expected to be done in somewhere 2020, so that it also satisfied the 1 year overrule, because it's not in hands of Enbridge to complete the sale within 1 year. Next, we have just a summary of how the measurement on assets should be recorded. It's pretty much noted by Morgan and Vince previously already. So the assets should be recorded as lower of the carrying amount and fair value, less any costs to sell the assets, and any impairment losses should be recorded in P&L, comprehensive income, as we saw in the case of Enbridge Pipeline. Next, we will be presenting and showing disclosures on how the discontinued operations are, what is the objective of discontinuing operations, paragraph 31, how the gains and losses are reported, that are referred by paragraph 37, and how the presentation of non-current assets and disposal groups are classified in paragraph 38. So according to paragraph 31, the objective is provided for the discontinued operation, how they are distinguished from the other operations, and their financial reporting is separate from the rest of the entity, or is separable. In other words, it's a component of an entity. It's a cash generating unit or group of cash generating units while being held for use. You can have an example of the one company we're going to using in this project presentation later on is Bombardier. They are into so many other uh, technologies in the transportation, and they were able to generate move one of the entity out of their regular operations, sell it out because they were not making profit out of it, or they saw better benefits in the other business areas. Continued from the last slide, um, yeah, the definition, as mentioned, it's a component of an entity, and so the Paragraph 32 explains it could be uh, a major line of business or a geographical area of business. Could be a company which is operated in multiple provinces in Canada, or multiple multinational company, and they start to close out in a specific country. Is it it's a part of single coordinator plan to dispose of a separate major line of business or geographical area of operations. For example, if somebody's not making a business enough profits, or if it's too costly to run an operation, they can probably shut down one line. And it could be a subsidiary, is a subsidiary acquired exclusively with the view of resales. So probably a company just acquired it to for reselling purposes in the future. We have already provided the Bombardier example already, which we'll discuss later in the case as well. Now I'll hand it over to Anne to represent the rest of the paragraphs in discontinued operations.
I will talk about the presentation and disclosure for discontinued operations. Paragraph 33, an entity shall disclose a single amount in the statement of comprehensive income comprising the total of the post-tax profit or loss of discontinued operations and recognized on the measurement to fair value less cost to sell or on the disposal of the excess or disposal groups constituting the discontinued operations. B. An analysis of the single amount into the revenue, expense, and pre-tax profit or loss of discontinued operations, the related income tax, and the gain or loss recognized on the measurement to fair value less cost to sell or on the disposal of the excess or disposal groups constituting to discontinued operation. If it is present in the statement of comprehensive income, it shall be presented into a section identified as relating to discontinued operations. C. The net cash flow attributable to be operating, investing, and financing activities of discontinued operations. D. The amount of income from continuing operations and from discontinued operations attributable to owners of the parent. If any entity present the items of profit or loss in a separate statement as described in the paragraph 10A of IAS 1, a section identified as relating to discontinued operations is present in that statement. Paragraph 34, an entity shall represent the disclosure in paragraph 33 for period present in the financial statement so that the disclosure relate to all operations that have been discontinued by the end of the reporting period for the latest period present. Paragraph 35, an adjustment in the current period months previously present in a discontinued operations that are directly related to the disposal of a discontinued operation in a period shall be classified separate in discontinued operations. The nature and amount of such an adjustment shall be disclosed. Examples of accumulations in which those adjustments may arise include the following: the resolution of uncertainties that arise from the terms of disposal transaction and are directly related to the operations of the component before its disposal. The settlement of employee benefit plan obligations provided that the settlement is directly related to the disposal transaction. Paragraph 36. If any case to classify a component of an entity as held for sale, the result of operations of the component previously present in a discontinued operation in accordance with paragraph 33 to 35 shall be reclassified and included in income from continuing operations for all periods present. The amounts for period shall be described as having been represented. However, an entity that is committed to sale plan involving loss of control of a subsidiary should disclose the information required in paragraph 33 to 36. When the subsidiary is disposal group that meets the definition of discontinuing operations in accordance with paragraph 42. Paragraph 37 is gain or loss relating to the continuing operations, where a non-current asset cases to qualify as held for sale. IFRS 5 paragraph 28 requires any resulting measurement adjustment to be present in the same caption in the statement of comprehensive income used to present a gain or loss, if any, recognized in accordance with paragraph 37. The intention appears to be that all gains and losses relating to any particular asset or disposal group should be present within the same caption in the statement of comprehensive income, not that gain or loss on all items held for sale should be aggregated within a single caption. Thus, for example, gains or loss relating to properties held for sale might be presented in a different caption in a statement of comprehensive income from those relating to subsidiary acquired exclusively with a will to resell.
Hi everyone, my name is Anne. Before moving to the last section, I would like to give you an example of the previous parts that Gajot and King have just presented. On the screen now is how the discontinued operations are presented on the financial statements of a company named Bombardier. About its background, this Canadian company is a jet manufacturer based in Montreal. On January 29, 2021, their transportation business line with the applied railway technology was discontinued, and following the IFRS 5 paragraph 33, it was presented on their consolidated income as a net loss of $20 million, separately from their loss from the continuing business. As per IFRS 5 33B, they disclose on the notes that the single amount of $20 million loss was after a calculation including the recognized gain related to the sale as well as the relevant expense recorded in this discontinued operation. And now moving to the last section of this IFRS 5, from the paragraphs 38 to 42 is the presentation and disclosure of the non-current assets held for sale. The keyword for paragraph 38 is separate disclosure and presentation. Especially the non-current assets classified as held for sale should be shown separately from the other assets in the financial statements. The liabilities and assets should not be offset and presented as a single amount. They should be disclosed separately either in the notes or in the financial position statement. The only exception, according to 39, is when the newly purchased subsidiary meets the criteria to paragraph 11 of classification as held for sale on acquisition. And remember from the last example that I showed you how the single amount of $20 million loss also include revenue and expense. While unlike the discontinued operations, here the income and expense from the assets held for sales should be provided separately in the OCI. According to paragraph 41, in a period when a non-current asset has been either classified as held for sale or sold, the company is required to have description of non-current asset and facts and circumstance leading to the disposal. Impairment loss or gain included in statement of comprehensive income, and if applicable, the reportable segment in which the non-current asset is presented in accordance with IFRS 8 operating segment. You may realize this example was mentioned by Gujot earlier when he talked about the measurement of assets held for sale. I want to go back to his example to show how Enbridge has followed the IFRS 541 to present and disclose their non-current assets. They describe the facts about their sale of the asset. The Line 10 was an old pipeline belonged to the company's liquids pipeline segment. It was sold to a subsidiary of United Refining Company in 2018. And an impairment loss of 108 million was a result of this Line 10 sale. It was included in their consolidated income. This 108 million asset impairment loss was also presented as a single line on the segment report as follow IFRS 541 and IFRS 8. And the last one, paragraph 42, is for an asset previously classified as held for sale. In a period in which a decision is made not to sell an asset previously classified as held for sale, disclose a description of the facts and circumstance leading to the decision and the effect of the decision on the results of the operations for the current period and any prior periods presented. And this is the end of our presentation. Thank you for listening, and we will see you soon in the workshop with more exercise and case practices. Goodbye for now.